You paid $180 this month to store a couch you haven't seen in 3 years. You didn't drive out there. You didn't check on it. You just paid. And that, quietly, is the entire self-storage business model working exactly as designed. Here's the thesis, stated plainly, because it's stranger than it sounds. Self-storage companies are not in the business of storing your stuff. They're in the business of renting you a small, locked room and then betting correctly almost every single time that you will forget what's in it, forget to cancel, and keep paying anyway. The stuff is basically incidental. The forgetting is the product. Let's start with the size of this thing, because it's bigger than most people assume. Self-storage in the United States is roughly a $40 billion a year industry. There are more self-storage facilities in this country than there are Starbucks locations and McDonald's locations combined. Something like 1 in every 11 American households currently rents a unit. That is not a niche business catering to hoarders and people between apartments. That is a mainstream, load-bearing pillar of the American economy, sitting quietly in strip malls and highway off-ramps, and almost nobody thinks about how the math actually works. So let's build it from the ground up, the way the operator does. Start with construction. A self-storage facility is structurally about as cheap as commercial real estate gets. It's a metal shell, some interior partitions, a roll-up door, maybe a keypad gate. There's no plumbing to speak of inside most units, no drywall finishing, no kitchens, no bathrooms per unit, none of the expensive stuff that makes apartments or offices costly to build. Developers often quote somewhere around $40 to $60 per square foot to build a storage facility, compared to well over $200 per square foot for a comparable apartment building. That gap right there is the entire secret of the industry's profitability before a single customer even walks in. Now compare that build cost to what a facility earns. A 10 by 10 unit, roughly the size of a small bedroom, commonly rents for somewhere between $100 and $180 a month, depending on the market, sometimes climbing well past $200 in dense coastal cities. Do that math per square foot annually, and self-storage frequently out-earns retail space and rivals luxury apartments on a building that cost a fraction as much to put up and requires almost no staff to run. Many facilities operate with 1 or 2 employees, sometimes none on site at all, just a call center and an app. Low build cost, low staffing cost, premium rent. That's the frame before we even get to the clever part. And here's the clever part. The advertised price is not the real price. Almost never. Walk through the actual customer journey. You search storage units near me, you see an ad, first month free, or $89 a month, some number designed to look almost too cheap to ignore. That price is real for exactly long enough to get you to sign the lease and move your boxes in. It's called a teaser rate, and it functions almost identically to an introductory credit card APR. It gets you in the door, it gets your furniture off the truck and into the unit, and then, quietly, over the following months, the price starts climbing. Industry data on this is remarkably consistent. Existing tenants see average annual rent increases somewhere in the range of 8 to 15%, sometimes more, layered on year after year, while brand new customers walking in off the street are still being quoted that same low teaser rate to keep the marketing funnel full. So the person who's been loyally paying for 3 years is very often subsidizing the deal being offered to the person who just walked in today. That's not an accident. Internal industry language literally refers to this as yield management, the same pricing logic airlines use, just applied to a locked metal box instead of a plain seat. But raising the price only works if people don't leave. And this is where the psychology takes over from the real estate. Moving out of a storage unit requires you to do the one thing procrastination hates most: physically deal with the stuff. You have to rent a truck or borrow one, take a day off, go through boxes you packed in a hurry during a divorce, a move, a death in the family, a downsizing you didn't want to do. Compare that to the cost of doing nothing. A card on file gets charged automatically every month. No phone call required, no decision required. Behavioral economists have a name for this: the path of least resistance combined with the sunk cost fallacy. You've already stored it for 2 years, so quitting now feels like it would waste the 2 years of storage fees you already paid, even though that money is already gone either way. The math says cut your losses. The brain says keep paying. The industry is built entirely on the brain winning. The average length of stay in a self-storage unit has been creeping upward for years, and in a lot of markets now sits well beyond 1 year, commonly cited around 15 months on average, with a meaningful chunk of renters staying 3, 5, even 10 years without ever fully emptying the unit. 10 years on a unit that maybe holds $12,000 of furniture you could replace at a yard sale for $600. Nobody sits down and calculates that trade at the start. That's the point. Nobody's supposed to. Here's another number that quietly reveals the whole model. Break-even occupancy. Because staffing and utility costs are so low relative to rent, a lot of storage facilities can turn a healthy profit at occupancy rates as low as 60 to 70%. Compare that to a hotel, which often needs occupancy north of 65 or 70% just to cover its far higher operating costs, or an apartment building, which needs to stay close to full to justify its financing. Storage facilities were built to be profitable even half empty, which means every unit that is full and industry-wide occupancy nationally regularly runs above 90% isn't just revenue, it's pure margin stacking on top of a business that was already in the black. Now let's talk about the add-ons, because this is where a mid-margin real estate play turns into a genuinely extraordinary business. Almost every major storage operator requires, not suggests, requires, that you carry what's called tenant protection or storage insurance on your unit, and if you don't already have your own policy, they'll happily sell you theirs. These plans commonly run somewhere between $12 and $25 a month. Multiply that across a facility with, say, 500 units. Most of them opted into the required protection plan, and you're looking at roughly $6,000 to $12,000 a month in near pure profit from insurance alone on a single property before a dollar of rent is even counted. Multiply that across a company with 2,000 facilities, and tenant protection plans alone can generate revenue in the hundreds of millions annually for the big players. The actual payout rate on claims tends to be low because most stored property never gets damaged, lost, or stolen badly enough to file, so this line item behaves less like insurance and more like a mandatory subscription fee wearing an insurance costume. Then there's the smaller stuff, which sounds trivial until you scale it. Disc locks, sold at the front desk for around $20, required by many facilities because a standard padlock is considered a security risk they can cut and swap for their own lock, sometimes literally, with a lock they then charge you a fee to remove. Moving boxes, tape, mattress covers, all marked up well beyond what you'd pay at a hardware store, sold to a captive customer standing in a parking lot with a truck full of stuff and nowhere else to buy supplies in that exact moment. Late fees, typically flat charges of $20 to $50, or a percentage of the monthly rent, applied automatically the moment a payment is a few days overdue, no phone call, no grace period conversation, just an automated charge, because automation is cheaper than customer service, and the fee revenue doesn't require either. And then, at the far end of the pipeline, there's the piece pop culture loves most, the auction. Storage auctions, the ones you've seen on television, strangers bidding on units full of mystery boxes, are real, but they are a much smaller and much less romantic part of the business than the shows suggest. When a tenant stops paying, most states require the facility to go through a formal legal process, written notices, waiting periods, sometimes 60 to 90 days before they can legally auction the contents. In practice, most delinquent tenants either pay before it gets that far, or the facility ends up disposing of low-value junk rather than uncovering a hidden treasure. Industry estimates suggest well under 5% of units nationally ever actually go to auction in a given year. The auction isn't a profit center in itself, it's mostly a cost recovery tool, a way to clear out a unit and get it back on the market for a paying customer instead of it sitting occupied by abandoned junk indefinitely. The real money was already made in the months of rent, the annual rent increases, and the insurance plan the delinquent tenant was paying before they stopped. By the time the lock gets cut for the cameras, the facility has usually already been made whole. The auction is theater. The forgetting is the business. Zoom out further and you see why Wall Street loves this asset class specifically. A huge share of the self-storage industry in America is owned by publicly traded real estate investment trusts, REITs, companies whose entire structure is built around collecting steady rent and paying most of the profit out to shareholders as dividends. Investors like self-storage REITs because the demand is famously recession-resistant in a very specific, slightly grim way. When people downsize because of a layoff, they need storage. When people go through a divorce, they need storage. When someone dies and the family needs to empty a house slowly, they need storage. Bad news for a household is often good news for a storage facility's occupancy rate. That's not a moral judgment on the industry, it's genuinely just what the underlying demand curve looks like. Life events driving customers in regardless of whether the broader economy is up or down. Let's put a full customer example together, in plain numbers so the whole loop is visible at once. Someone signs a lease at $89 a month for a 10 by 10 unit, the teaser rate. Within the first year, the rate climbs to around $105. They're required to carry tenant protection at $15 a month. They bought a disc lock for $20 on day one. 18 months in, another increase pushes the rent to about $120. They meant to clean the unit out after 6 months. They're now at month 24, having paid something in the ballpark of $2,800 total, rent and insurance combined, to store furniture that, if sold today, might fetch $400 or $500. Nothing illegal happened anywhere in that story. No one lied. The price increases were disclosed in the lease. The insurance was optional in the fine print, mandatory in practice for anyone without their own coverage. Every step was, technically, a choice. And that's exactly why it works, because it never needs force, it only needs friction, plus enough time. Now the fair part, because this business model doesn't apply the same way to everyone who walks in. People using storage for genuinely short, well-defined windows, a 2-month gap between a lease ending and a new home closing, a business storing seasonal inventory it actively rotates, a contractor keeping tools and equipment in active weekly use, are getting a completely reasonable trade. They're paying for flexible space they'd otherwise have to build or rent commercially. They know exactly what's in there, they visit it, and they close the account the moment they don't need it. For those renters, storage functions exactly the way the industry markets itself, a useful, practical, fairly priced convenience. The trap isn't the product. The trap is indefinite duration meeting human procrastination, and that only bites the renters who let a 2-month plan quietly become a 2-year plan without ever making a new decision about it. So what does all this actually mean if you're the one with a card on file at a storage facility right now? It means the operator is not hoping you forget. The entire pricing and staffing model is built assuming a large share of tenants will. It means your great deal from move-in month is very likely not your current rate, and checking your actual current bill against what a new customer is quoted today is often the single most useful 5 minutes you can spend on this. It means the required insurance line is worth comparing against your renter's or homeowner's policy, which may already cover stored property for far less. And it means the real question worth asking isn't what's in the unit, but what would it cost me in time and gas and one Saturday to find out, versus what I'll have paid by this time next year to keep not knowing. That's the actual math behind the beige metal buildings you drive past without a second thought. Cheap to build, expensive to leave, and profitable largely because leaving takes more effort than staying. The stuff inside was never really the product. Your inertia was. If you want more of these breakdowns, the real business models hiding behind ordinary everyday places like this, subscribe and hit like so this series keeps